Today we have two people from the National Association of Realtors who will be with us today talking about our current topic. And Austin Perez from NAR and Cyndee Haydon from NAR, though Cyndee is coming to us from Tampa Bay, which means that she's in the midst of storm preparation. So welcome to Austin and Cyndee, and thank you so much for taking the time to be with the Williamsburg Realtors Association.
Thank you for having us.
Thank you, Lynn. I appreciate the welcome to everybody, and good morning to our Realtor members. I am Susan Gaston. I'm your legislative consultant, and I'm down in Jacksonville, North Carolina, doing some storm prep for our deployed Marine, and also getting ready, we hope, for a homecoming in the next few weeks, but that even is storm dependent to some degree. So I am cute, but way too casual to go on camera this morning. So I hope you all will forgive me for making that decision. But I am thrilled to include and welcome and introduce all of you to my colleague, Austin Perez, and to Realtor Cyndee Haydon, as Lynn mentioned, from Florida. I've had the pleasure of working with Austin now for several years, primarily along the issue of insurance, but more recently and more relevant in recent years with Austin on the issue of flood insurance and other natural disaster insurance, which today, perhaps very notably, and it was not planned this way when we first scheduled Austin and Cyndee to join us, but here we are really on the cusp of one of the first major storms, hurricanes, to hit the coastline in the US. So this is very, very timely. But I've, again, had the pleasure of working with Austin on these issues. I've worked with him as a member of a couple of his work groups and as a member of the insurance committee. And I'm telling you, there is no better person to lead NAR on federal housing, valuation, insurance, and commercial issues than Austin Perez. He is what I would characterize as a subject matter expert on federal flood insurance. And as a staff director to the committee, he works hand in glove in helping NAR to position itself on insurance and other related public policies. He was a lobbyist with the American Farm Bureau for many years, working on environmental, labor, and immigration issues before he joined NAR, which, Austin, you're coming up on 15 years with the National Association of Realtors, which is hard to believe. But we really are just so fortunate to have his expertise be part of our panel today. And you will realize why we are so blessed to have him be part of this. And joining Austin is a fellow realtor for all of you, Realtor Cyndee Haydon from the Gulf down in Florida. And Cyndee is the vice chair of the National Association of Realtors Insurance Committee, and will soon move into that chairmanship role, where she already takes a leadership role without a doubt. She's been very strong and very helpful on, again, positioning the National Association of Realtors on issues, particularly on the topic that you'll be hearing today regarding risk rating 2.0. And I do want all of us to keep Cyndee and her family and her community and our hearts and minds today, from down in Clearwater and St. Pete and all of the Gulf area, because they are really storm prepping. And we know it's a frightening time. And for you to take that time away from your personal preparations today, Cyndee, means a lot to us, but it also is demonstrative of how much you believe in what we do along these policy issues. So I welcome you both. We're honored to have you. And I think with that, I'll flip it over to Austin, and he will give you all the most extraordinary information on risk rating 2.0 from a policy perspective. And then, of course, Cyndee will be able to bring in the practitioner's perspective and how all of this is so important to what you all do day in and day out throughout Hampton Roads, the second most flood prone area in the country. So thank you both. I'm going to flip it to you, Austin, and we'll take questions and answers. I'm sure there will be many. And I'll add real quick, while it may look like we don't have a lot of people on at at the actual time that we're live, what we've noted is, having recorded this and then we will upload it to our YouTube channel, we will have a significant number of members who watch this maybe even more than once. And so for them to be able to see it when they've got the convenience and the flexibility to watch on their own schedule, really we will expose this information to a number of our membership. So don't be distraught if you don't see a number of faces in front of you on the live Zoom. We will end up having 60, 70, 80, 100 members watch this repeatedly. So we appreciate the facts that you're about to share with us.
Cyndee, you want to kick us off?
Yes. Can you go to the next screen, please? Okay. Will you do the next one just so I know where we're going? I'm sorry. So just keep it. Okay. So again, this is kind of the area we're going to cover, overview of how we got here. Austin will take us through the legacy, and then we'll talk about what's new and what you need to know as realtors to help your clients going through this. I think the most interesting thing is, up until right now, I was saying that there were 3 things that had happened that made me passionate about the topic of the NFIP and flood insurance and affordability for people in our country. And the first was, I had a house fire 33 years ago, and I lost everything. And so I'm not a stranger to what it means to, again, have resiliency, and I had good insurance, get back on your feet. But I also know what it is to have to decide at this time, you know, what can fit in your car that are your possessions to keep your people safe. And when Biggert Waters happened, I happened to have 2 clients that in particular had bought homes, and Congress went backwards 6 months and said, if you bought, then the flood insurance kind of changed. It jumped to a full rate, and there was no payments and other options. And so I'll never forget looking into a veteran's eyes who'd done everything correctly. And he just said, like, I lost everything. I mean, I basically foreclosed on who can write a check for $14,000 for flood insurance. So again, NAR, you know, as we talked through the process, and then I had friends in Hurricane Andrew. And so hopefully my story, those are the 3 I'll be referencing after this week. But anyway, it is real. And again, it's important that we help educate our buyers and sellers in the process and keep our community safe. Go ahead, Austin. So when you look at the National Flood Insurance Program, it's been challenged and been in the red for so long, because if you look over time, as we're looking at right now, the storms are going into places and having a much greater impact. The cost of storms over time, just by the very nature of our coastal communities or other communities being built up, the cost of replacement, the cost of rebuild, the cost of remediation, all is increasing. And so the money that was being collected on the old plan was not enough to see, as you can see here, what was being paid out. Go ahead, Austin. When I talk about the veteran and looking in the eyes of what this is, a past chair of our committee, Stephen, who he got a flood insurance policy that was $87,000 for a $300,000 building. And I'm sure all of you on this call can realize that the insanity of that. I mean, even in the riskiest places, as you mentioned, you guys are there as well as we are. We don't have a total loss every 3 to 4 years. So to our credit, and to hopefully all of you supporting our advocacy efforts through the Realtor Party, we, NAR, put together an NAR insurance committee for 10 years. We worked hand in hand with FEMA. Thank you, Austin. And this kind of lays out that timeline. But it was a real model for what I think we need to do in the future, which is, you know, we had the federal government and we had the credibility to work and orchestrate what would be a good long-term solution without having immediate catastrophic impact. So again, as you know, last October, risk rating 2.1 rolled out for any new policies. And then we had we'll talk about what we have for the people that went past that. But again, super proud of the work that NAR has done on the behalf of every member. And as we look at more and more climate financial risk, it affects all of us, and flood's the #1 disaster in all 50 states. So again, really, really proud of the work they do. Go ahead, Austin. I'll turn it to you.
Great. Thank you very much for the opportunity. So just so it's clear, I'm your staff representative in Washington, DC. I'm the public policy expert on insurance, federal insurance matters. It pretty much boils down to flood insurance, terrorism, healthcare. But I've been asked to talk a little bit about the new pricing system that FEMA rolled out for flood insurance. And I'm so fortunate to be able to work with a group of leaders and also staff, Susan, a committee of 50 of mostly your peers who have probably forgotten more about flood insurance than I'll ever know, as I've sort of studied this over the years. But anyway, thank you very much for the resources in Washington, D.C. to carry the message that the members as represented, your membership is represented by the insurance committee going to FEMA and to Congress. And so before I get into how the pricing for the flood insurance policies have changed, I want to talk a little bit about the old system. How was it possible to see an $87,000 rate for a 300,000 single family home? So the first thing I realized as staff director to this committee is I'm representing real estate professionals. Insurance pricing is something done by actuaries. So one of the first things we did when we formed the insurance committee, I was directed to go and find actuarial experts who could help us make heads and tails of what was going on with flood insurance pricing. We hired, the board of directors put forward a lot of money. We ended up hiring one of the top 3 actuarial consulting firms in the country. That firm put together not only a diagnostic, a report on what the problems were under the old system, but also a solution. So NER actually sponsored a proof of concept. How should FEMA change its rating system in order to adapt and be reflective of a 21st century home flood insurance program? And it's the first time I've been lobbying for 20 years. It's the first time where I'm going to share with you, FEMA pretty much scrapped the pricing for the flood insurance program, not only, but in large part because of the efforts of folks like you and NER calling for changes. But it's the first time in my 20 years where FEMA pretty much took the solution put forward by realtors. And that's what I'm going to share with you today. So first thing these actuarial experts did with the Milliman group is diagnose what the problem was. So I'm going to share with you some slides that they shared with the committee very early on. And I want you to see that if nothing had happened, if FEMA had not adopted pricing changes, flood insurance pricing changes, you would be seeing rate increases under a 50-year-old system. Now, if you look at some of these examples of technologies that were available 50 years ago, I think it becomes immediately clear that FEMA did not have the tools they needed in order to price flood insurance for their program. Think about the work that you do serving clients. How many of you think you would be serving your clients for very long if you were limited to 50-year-old real estate technologies and you could only give your clients 2 pieces of information in order to help them make potentially the largest financial purchase in their lifetimes? That's what FEMA had to do. It was not only limited by 50-year-old technologies, but in order to characterize the price, they could only use 2 pieces of information. They could use the height of the building relative to the base flood elevation. That's the 100-year flood estimate, FEMA's estimate of how high the waters will rise in a 100-year flood, and the special flood hazard area, an area detailed on the map. Are you in or out? So again, think about your clients. If your clients were looking at property and all you could tell them is two pieces of information before they made a purchase, maybe it's the address and the number of square feet. Maybe it's the number of square feet and whether there's a school down the street. Pick any two pieces of information, and that's all you could give your client. That's one of the reasons why the program was looking at an $87,000 flood insurance rate, because the system was 50 years old and they could only use two pieces of information to characterize the price for every property in the United States. Here's an example under the 50-year-old system. It's probably not uncommon to what you all are seeing there in Virginia, where you have a property, and this is under the old system, that could see a $6,000 rate, but you go right across the street, the neighbor's only paying $400. I think reasonable people would agree that flood risk, floodwaters don't stop at a line on a pavement. The risk is probably not that different between those two properties across the street from each other, but under the 50-year-old system, there are large cliffs in what the rates would be. And what I also illustrate in the bottom left-hand corner, those two green dots, you can see risk one, risk two. Those are the properties that you're looking at the top of the screen. You can see the $6,000 property is the green dot in the purple area. This is the area where you're required to get flood insurance for a federally related mortgage. And the property, the risk two dot right across the street, $400. So if you kind of squint a little bit, you can see risk three in the right-hand quadrant of the lower left-hand box. So that's a property about, I don't know, 3-4 blocks away from the $400 property that you're looking at the top of the street. And that person is paying $400 too. And it might surprise you to learn that if you keep going, this was in Tampa Bay is where we got those two, risk one, risk two, risk three. If you keep going another 1,500 miles into the center of the United States to Columbus, Ohio, you can find that $400 policy again. Everyone is charged pretty much the same rate under the 50-year-old system. It just depends on whether you're in the flood zone or outside the flood zone. In the flood zone, you're actually kind of lucky because there's a second piece of information, not just whether you're in or out, a second piece of information which is considered for purposes of pricing, which is how high is your lowest adjacent grade, where the ground touches the lowest point of your building relative to that 100-year flood level is estimated on a FEMA map. So that's two pieces of information in the special flood hazard area, one piece of information everywhere else in the country. What I want you to take away from this is the price did not follow the risk anywhere in the country. A lot of people were being overcharged. A lot of people were being undercharged. And I gave you a $6,000 rate, but you could see an $87,000 rate in a V zone just down the street from that property. All right. So talking a little bit about the old system, I want to make sure it's clear. It wasn't do nothing. We have a perfect Nirvana-like system of pricing where everyone is getting a rate that's property specific and fair and appropriate for their risk. So what happened under the new system? Our board of directors, as recommended, advised by the insurance committee, adopted three principles. What would we like to see in a new rating system? Risk rating 2.0, the new pricing system, checks all three boxes, meets all three criteria that were proposed by the insurance committee and adopted by NER's board of directors. And again, what's unusual about this is, so box number one, it has to be based on the latest science and collaboration. What's interesting about this is I mentioned that we hired actuaries, some of the top actuarial, one of the top actuarial consulting firms in the world, to help us propose a solution. Well, FEMA went on to hire that very same firm. So the risk rating system that was built out, risk rating 2.0, the new pricing system, was developed by the very same actuaries who we paid to develop the proof of concept of what we'd like to see in a new pricing system, which is very interesting. But not only that, but FEMA had to collaborate with all kinds of scientists from a number of disciplines across the flood space. You had building science, you had engineers, you had academics who had been working on it, underwriters, mitigation experts, as well as meeting with the insurance committee. And Susan was a part of this effort, meeting with the insurance committee for a number of years. FEMA wasn't able to take all of the recommendations of our members, but having seen behind the curtains and watching those that collaboration go on, FEMA took to heart a number of the suggestions offered by those realtors. And these are 50 realtors from across the country, like I said, who are not only real estate professionals like Cyndee, who you heard, but know just about everything there is to know that a real estate professional can know about flood insurance. So it's really been a pleasure and a privilege over the last 6 years to watch that. So criteria number 2 that the board of directors wanted us to push for in a new pricing system is it has to be property specific. And that's not unlike what your customers ask of you when you're serving them in a real estate transaction. They don't want to know about the community. They don't want to know about the city. They want to know about the property. They want to know how many square feet, what are the electricity bills, how many schools are down the street, how good are those schools. They want to know property specific information down to the building specific level. That's what Risk Rating 2.0 does. It now identifies the price of each property based upon the building, the specific building, not whether the property's in a flood zone or whether an elevation certificate shows its lowest adjacent grade, its lag is relative to the 100-year flood level. Moreover, Risk Rating 2.0 now uses a dozen rating variables specific to each building. So they're no longer using just 2 pieces of information to price a building. They're using a dozen. Things like how far away is the water? Is the nearest water a river? Is the nearest water an ocean? What's the main source of flood risk to that property? Is it storm surge, as Cyndee is alluding to on the Gulf Coast, as a hurricane approaches and water can knock over a concrete wall with about 2 or 3 feet of water? Or is it river rise, like in Columbus, Ohio, where the flood risk is, or in Houston? After Hurricane Harvey, 80% of the properties flooded outside the special flood hazard area where FEMA requires flood insurance. Why? Rainfall pooled in the sewer system, backed up, pooled. And that's why 80% of those who paid out under the NFIP, under disaster relief in Houston, was due to rainfall flooding called urban flooding. So that is also accounted for in the new pricing, which is not accounted for in FEMA's latest maps. Last thing I want to mention is it's also based upon the replacement cost. So it's one thing if you have a multi-million-dollar property that's paying an $87,000 premium. 87,000 relative to a multi-million-dollar property. I mean, it's still high and there's no one in the program that has that level of risk, but it's very different than a $300,000 property. Why would you charge more of a higher value property than a lower value property? The reason why it is because it's likely to cost the program more. So what it costs to rebuild the property is also a rating variable factored into the new risk rating system. So if you have a multi-million-dollar property that it costs to rebuild, the chances that you're going to pay out the maximum $250,000 under the NFIP under statutory law, the likelihood is a lot higher that that multi-million-dollar property is going to pay out than if you've got a $100,000 property to rebuild. That $100,000 property is never going to reach the maximum. So the higher the cost it is to rebuild, the more your rate is going to be. And I'm going to talk about the limits, and Cyndee's going to refer to, no one's going to see $87,000 anymore under the new system. That's just ridiculous. FEMA couldn't explain that. The actuaries couldn't explain that. No one could explain that number. That number is gone. But the point is that the property is property specific. It's based upon a dozen variables, and it also includes the cost to rebuild. It's no different than any business out there. When you're trying to figure out how much you're going to how you're going to stay in business, you have to cover your costs. And it's got to include a normal rate of return. Federal government doesn't make a profit, but it has to be able to cover its cost over the long run. So if a property that costs more to replace and is more likely to flood or hit the maximum limit under the system, then FEMA's going to have to charge more of that property in order to cover its costs. It's that simple. So a dozen factors, property specific. The last point I want to make is it's also the private sector has been testing out, proving a lot of these technologies that Milliman gave FEMA, that FEMA has adopted under the latest rating system. The private flood insurance industry, since Hurricane Andrew, Cyndee mentioned 1992, bunch of insurance companies went out of business because they were not charging enough for Hurricane Andrew. So a lot of smart people got together and they developed a new system of rating private market insurance through catastrophe modeling using satellite-based lasers or airplane-based lasers called light detection and ranging, LiDAR. There's a lot of sophisticated technologies that have been developed, percolating over the last 34 years, been proven out. Risk Rating 2.0 uses a lot of those same private sector off-the-shelf proven technologies in order to figure out the pricing under the new system. So I've got for you at the top of the screen, what would have happened if there was no Risk Rating 2.0, if FEMA had just continued on with the 50-year-old system and two pieces of information? The answer is the legacy rating system, everyone would have seen their rates go up. Under the new system, for the first time in NFIP history, 23% of the 5 million policyholders, their rates will go down. They will go down an average of about $100 per month or $1,200 per year. The another 66% will pay just about the same that they would have paid under the old system. They will see a small increase per month, and some will see a modestly larger increase than they would have seen under the old system. But here's what I want you to see in the lower left-hand corner. Even those people who are seeing the largest increases under the new system, the maximum that they will pay under the new system is $12,000 per year. Now, $12,000 is a lot of money, but it's not $87,000 per year. And so we asked FEMA, just as a point of reference, because we went to Congress and we rolled back the $87,000 rate and delayed that rate for 10 years while we worked with FEMA in order to fix the system. So Risk Rating 2.0, we went to FEMA, we asked, if you didn't do Risk Rating 2.0, what's the highest single family policyholder paying in the program today? And the answer is $45,000. So those property owners and roughly about 10,000 policyholders in the program under the old system were paying above $10,000 and on their way to an $87,000 flood insurance rate. Under the new system, they never get to $87,000. They never go above $12,000. So for 10,000 policyholders in the program, at the end of this glide path, and FEMA and Cyndee will explain what we mean by glide path. At the end of that, they're looking at a $40,000 to $60,000 rate decrease by the time they reach their full risk rate. So with that, I will turn it back over to Cyndee.
Thank you, Austin. Go ahead to the next slide for me, please. So Austin gave you guys a great idea of the fact that I like to use the analogy, if you've ever heard the joke that, you know, if you put a frog in boiling water, they jump right out. And that's kind of what we had happen with bigger waters. And then we had grim waters, and we really became like frogs where that boiling water is going up and up and up, and it wasn't sustainable. There was no end in sight. It would go up indefinitely. So again, he talked about how old the policy, the rates, the methodology was, and that 2/3 of the homes were overpaying, as well as the fact that it wasn't sustainable for taxpayers. So go ahead, Austin, please. So just kind of recapping what he was sharing, the new rate is $12,125,000. Again, a 73% decrease over the old system. And obviously that number would have gotten even larger because there was no stop. And 23% of the people across the US saw an immediate decrease. I'm imagining, and we could get the data for you, but in Florida, we actually saw a decrease, right? So places that, like yourselves, are at high risk, many times we're overpaying. And so again, it's just good to understand. And then, you know, again, if you've done remediation or other things, then those factors can be used. But on the other hand, you don't have to have an elevation certificate. And so what that means for realtors is you are able, when you take a listing, if your client doesn't have flood insurance, to get a quote, right? And if you're working with buyers, to get a quote, because it is a big part of affordability. And again, I just bought a waterfront home in June here, and the owner did not have flood insurance. And so what that meant was that, you know, again, the policy goes to the new rate, the rate where it is, which was $6,000. But again, if that was cost prohibitive, then I don't need to spend money on inspections, appraisal, and all that stuff. And we used to have to wait much further in the transaction. And then we're going to talk about the glide path, which existed before, but we'll go over it so you understand for your clients. And then again, the elevation certificate is only needed if it helps you. Go ahead, Austin, please. So the amount of coverage is still the same on both residential and commercial policies. And this actually, the way it works now, it says the buyer can assume or transfer the seller's policy. Actually, in the old days, if any of you did it, you had to actually get a seller to sign to agree. And oftentimes what I ran into is their insurance agent didn't want to, they were creating a lot of friction, especially if they weren't keeping the policy. So now, as a realtor, if I have the declaration page for the seller's flood insurance, and I just make that a policy when I take a listing now, then the buyer can to give that to their insurance person and can get that insurance in effect transferred so that it has the same rate as the seller. You still have, if it's your primary or secondary, you still have the 18% or 25% max increases, but we're going to show that historically, at least the last 5 or 6 years, that's really hovered more around 9%, which is why your clients probably, again, when they see that, they start doing math and they're like, oh my gosh, it's going to jump. But nothing in this pricing change affected the mechanism for that at this point. So it stayed the same. You are still required to have flood insurance if you are in special flood hazard areas, again, and you have a federally backed mortgage. And our communities, across the country and communities here, we continue to work to be more resilient in the government aspect. And a lot of that involves what you're doing right now and your cities and being, educated and helping people make decisions and educate them about flood insurance to get that discount. And then again, the elevation certificates are optional. So here's the glide path idea that we were talking about. And this is just an example. If we use the last few years, it had increased at 9%. But again, we never know based on what the fiscal needs are. It is capped statutorily at 18% if it's your primary or 25% if it's not your primary. So imagine that you own a home and right now you're paying $3,000 for flood insurance with the NFIP. Then even though, say, the new rate was $10,000, you can see that as the owner or the buyer going forward, that you could take advantage of this glide path. And as long as you remain in force, it would take you almost 14 years to get to that full rate. So again, that was helpful because people were having to make plans financially and not seeing those big jumps, right? So again, that was a big piece of maintaining that. Go ahead, Austin. So let's look a little bit about what that would be in real life. So here is a lower value coastal home, and you can see where the legacy system, they were paying $474. And actually in a VE flood zone, that's the wind, the velocity. Again, I don't know where it is, but the price must be very low. So in the 2.0, 400,000, you see the value of the home calculated in with the other characteristics in the legacy, and that premium is $893. Now, if you own a home and you were paying $794, then $794 plus 18% is the max that you would pay for the next year in primary, even though it's average 9. So nobody's going straight to the bigger number if you have a policy in force and you keep it in force. Go ahead, Austin. So here is a severe repetitive loss. So this is unfortunately way too much on my mind today, but the bottom line is that FEMA has kind of given everybody a clean slate. And so the answer from there is that everybody's policies are going to come out, but then once you have a claim going forward, they will look at a 20-year rolling average. So if there were claims in the past and those kind of things, then you're going to see it. Why that matters to us as realtors is as we are helping buyers in particular, looking at homes in areas that you may know flood often or have issues. We have a neighborhood here in St. Pete called Shore Acres, and it's known for repetitive flooding. If a buyer were to buy right now in 2022, and they would get a quote for a premium that says that it's less than $2,000, whereas the previous person's quote or what they were paying would have been $7,200. I think this is where, as realtors, we need to do a good job of understanding what that means, because again, if something like next week happens and all those homes have flooded, the future is going to be impacted, right? And again, you want to be aware. If you want to know about a home and it's flooding, the only person that FEMA is allowed to reduce it, or the government is allowed to release that to, is the homeowner. I know, Susan, you guys were working in your area with your representative in Congress to try to help us have like a flood fax, which we strongly would love to see, just like Carfax, that if you're buying, you should know that history. But because the federal government privacy laws, that is not an option at this point. So we continue to work, and we thank you guys for your work in leading that charge to say, hey, this should just be transparent, and then people can make better decisions. So again, even though, like I said, if you look at the value of this house at $229,000, that policy at $7,000 is a significant piece, but again, it is one that has had repetitive losses. So like I said, hopefully coming today, you'll understand that if you get a big savings, great, if it actuarially makes sense. If not, you might want to just have your person talk to their insurance person you introduce them to, and just understand the history of the area and what that might look like, so that again, you have happy clients and they're not caught off guard. Go ahead, Austin. Okay, so here was an idea of a property that we found in my area. And again, it's someone built in 1967, a ranch, slab on grade, probably sitting at 5 or 6 feet above sea level, with base elevation being about 10. And pre-firm means that it was built before the whole, elevation and all that kind of stuff. And so the codes and everything today wouldn't allow it. We would have to elevate a property to build that. So their grandfathered previous premium was $2,488. The problem with that, and it goes back to what Austin explained to you, that property is worth 1.5 million. And so for them, the odds, if they have a flood, of there being up to $250,000 of damage is much higher than the one we just saw before at $220,000 property. It's not, there's no way it's going to go to $250,000 worth of damage. So probably one of the biggest places you're going to see an adjustment is going to be on higher price properties, because what they know is that when a flood occurs, the cost to remediate it is going to be on the higher end of the 250,000 than the lower end. So the new risk rating 2.0 rate for this would be $7,669. Now, I told you I just bought a home. That would be someone who didn't have insurance, right? Like the home I just bought, the owner was self-insured. She did not have insurance. And so I'm paying I had to go to the true rate, which was $6,000 a year. Now, if she had insurance then, and was paying $2,488, I would have had a number of years to get to that 6,000, as would you and your clients if you run into that similar situation. Go ahead, Austin. And then Inland Riverine, again, a little bit different. So this one was a $200,000 house built in the 1900s, slab on grade in a flood zone, one floor, under 1,000 square feet, paying almost 6,000 a year. Again, when I did the math, and I apologize because I did not look at the math this morning, but before, when you put $6,000 over 200,000, proportionally, that's a huge number compared to 2,400 over a 1.5 million, even the $7,000 over a 1.5 million. And this really goes to why when you hear risk rating 2.0 and the message about equity was, again, for the proportion of the house, for the value of the house, are we all carrying our fair share, including the risk, but also the valuation on it. So this is where you can see that they would actually see a big decrease to $1,547,000. And just so you guys know, we have an insurance specialist that NAR has hired that does all of this. So one of the most important parts is, and I'm sure your brokers would love to hear me say, we have to stay in our lane. So our job is really helping people get to somebody who understands the new risk rating 2.0, understands how flood insurance works, and can give them good advice, because not everybody has taken the time to be trained and could create some issues. Go ahead, Austin. So, some things that as you are continuing to sell now that risk rating 2.0 is fully rolled out, you're gonna, for me, for a long time, ever since 2012, because we were ground zero for Biggert Waters, we had 57,000 pre-firm homes that were impacted. And so every home I sold, and I specialize a lot in the waterfront, I would have to tell a client that I don't know when and I don't know what, but I was here when clients did everything right and they got a bill for $14,000 for flood insurance, and you just need to know. And so now I feel so much more peaceful about selling a home. Even myself at $6,000, I know the actuarial rate. I don't have to guess, am I going to get like slammed with a big unexpected bill that I can't pay? I mean, going into that purchase, a buyer can make a better decision on their own risk as well as affordability, in my opinion. And so I find that buyers are making better long-term decisions. And I think that, again, Austin and I have this conversation all the time. Different people have different, are going to value it, right? So I bought a home on the water. It's not elevated. And I understand that, come Thursday, it's going to cost what it's going to cost to rebuild it, right? So, but I bought it from a seller who said, I no longer want to be subject to being in a high risk area. And that was her motivation for selling. So again, it really honors what people value, but also per our code of ethics, it's letting us give them information to make a decision that fits for their family. Because as I can tell you sitting here today, the safety concerns and, again, truly, if we get a 7 to 10 storm surge, right? I mean, we're going to be looking at loss of life. We're going to be looking at stuff, and so if people don't make good decisions. So again, you weigh that all into the living in paradise, right? So, again, this slide, we can probably update it, but you may find that when your clients get a renewal notice, they may have some questions, because what will happen on the new renewal is it would actually show the full amount of the true actuarial rate. So in my case, $6,000, but if my neighbor who's paying $3,000 got her renewal, on there it's going to say $6,000, but she's not paying $6,000. She's going to pay $3,000 plus 9% right now. So just understand that if somebody asks you that or freaks out, that's what that is, and just help them understand that NAR has worked hard with FEMA to be able to be truly transparent and help them understand. Up until a few months ago, what we told people was, if those numbers make you, we work with retirees and stuff, but if those numbers make you nervous, it's a seller's market, anything's selling, right? So maybe you want to make a different decision. But it is the number that kind of lets you plan. Or if you're looking to retire in 5 years, maybe it's not going to work with your budget and maybe you're going to do something else. But it gives people, now the glide path gives people a true planning horizon to make good decisions for their family. What it also does, quite honestly, as realtors, is it doesn't immediately distress all flood property at the same time, which would be catastrophic for values, communities, everything. It's letting people naturally make those decisions, naturally migrate, naturally remediate, do those things in a way that is much healthier for our property values and our real estate markets, in my opinion. So again, the key factor is to work with an insurance agent who understands risk rating 2.0 and can really help you. I will tell you a pro tip. I don't advise this, but I had a situation recently where a property was purchased and I got the declaration page from the seller. The buyers had not picked up the flood insurance. They were just in limbo anyway. Then they got divorced, right? They're in the middle of getting divorced and I'm selling the property 5 months later. So the difference in this house between the old and the new was like $5,000 a year in flood insurance. And the specialist that NAR hired was able within that 12-month period to my buyers who were now sellers had to buy the flood policy, but we were able to get it back and pass on a glide path rate to the new buyers, which you can imagine, $5,000 a year is, on par $400-450 a month. So when you're looking at payments, it makes a big difference. So again, if you run into some quirky things, Austin can certainly be a resource to put you in touch with, whether it's FEMA or insurance specialists. Again, you'll know it when you see weird. I hope you don't find it, but again, we're here to support you guys. If you find it, just know it seems to, I seem to find it. So you're not the first one going there. Go ahead, Austin. So, I started my career as a developer for IBM and, Austin and I often joke about the fact that really, when you look at this 50-year-old system, it was like a new operating system. And so with anything, there's going to be, things that are messy or quirky or whatever. Quite honestly, we've had a pretty smooth rollout, a pretty smooth process. So, but if you have somebody that gets upset or you find something that's not working as you'd expect it, we like to say, just pause, breathe, and get the facts. And what that means for me is get the declaration page of the property, because how many times, just like when you start, I just took a listing in this and the seller's telling me, oh no, this other house sold for quite a bit more. And it didn't, but in her mind it did. And those aren't the facts. Well, again, there are people that can help. If you have that declaration page, then everything is, you can be sure that you're getting the right information. But sometimes you hear, oh, well, they said theirs is this, they said that. I recently ran into, it wasn't through the NFIP, so someone had private insurance. So again, coming over into NFIP, there's not going to be a glide path, right? So all of those things, it's for Austin and myself and the team to be able to help. We just need the facts. So make it a point. And my best practice I would share with you is ask your seller for their declaration page on their flood policy. Keep it in your file, even if nobody decides to get flood insurance and they're self-insuring. If something happens, you like my crazy divorce people, you might find that it's a godsend. Go ahead, Austin. Well, change has come, so we're good here. And one of the things that NAR did a great job about, and Austin, always is thinking ahead as to how to communicate, educate, but also mitigate our risk. So while the team and Susan and the insurance committee and our work groups and FEMA have all been working on this, NAR made made a brochure on risk rating 2.0. And again, best practices are be the source of the source, not the source. So you have a wealth of information on the NAR site, as well as flyers to give out. And so again, you can make them aware without taking on additional liabilities. And really the beauty that I feel so strongly about in my own business has been the ability from, prior even to making an offer, but day one to be able to understand the impact and the cost of insurance on the purchase and the payment and what's comfortable for buyers so that everybody's having a smoother transaction. And this one on don't assume, that's really for Austin, for all the times I've gotten my hand slapped because as someone kindly said to me at the recent leadership summit with Kenny, they're like, oh, what committee do you work on? I said insurance. And they looked at me and they're like, well, that's a nerdy topic. It doesn't seem like you. So it is where my nerd comes out. But I think you guys that are here with us today know why it matters so much to me and why I want people to have the best information, because we are truly impacting families' lives. And speaking from experience, it matters to me. It matters to our communities. And I can't think of another natural disaster that, again, the fact that all 50 states are impacted, if we can help people make better decisions and be safer, again, I'm proud of NAR and our ability as volunteers to do that. So it's an honor to be here. I don't know, Austin, I think there might be one more slide. Again, I would just ask you, Kenny's theme next year is riding with the brand. And what that means to me is that we're telling our story, right? I mean, I give because if we have to have a seat at the table, but we have to have champions. And also I tell my clients that I'm advocating for them and our community and our neighborhoods. And so again, even for people that are just making a minimum investment, the calls to action, the things we do are important. I mean, we have not had flood insurance reauthorized yet, to the best of my knowledge, that expires at the end of the week. So again, all of these things matter. As we said earlier, get the facts. If anything sounds weird or somebody's making a big claim, then just get the facts and we can help you understand and help you explain it. And you're going to want to connect them with insurance agents. And you always have a team here to support you and a broader range of experiences across the country. So you don't have to, I mean, it's like I said, don't feel like you can't ask or don't know. So yeah, that's a good thing. And I got people walking around, so I apologize. My focus is like somebody's carrying boxes and getting stuff ready. So I think, Austin, is there another one? So here I mentioned there's a huge wealth of resources on NAR. Again, we'll provide these slides to the team there. And so feel free and like I said, reference and get the information that you need. I think you'll be happy that's there, as well as, some different videos. And let's see what else. Go, Austin. There you go. So Austin has been there since the beginning for NAR as they made this this committee. I will tell you that we continue as a committee to look at all the natural disasters and impact. And we've been have work groups working on fire. We're looking at drought. And so again, NAR does a great job of helping us see, where's the puck going and how do we have policies that support our members and our communities and private property rights. And so it's an honor and a pleasure to be here. And if I can ever be of assistance, I'm happy to. Thank you.
Cyndee, that was both of you and Austin. Those slides were so chock full of information. Especially the last slide on the resources with all the links. I don't know if you all are comfortable sharing that with me, that we can then push out to our members, but all of these, obviously over the course of time, I've had a chance to look at, and if we could share these with our members, I think that would be a huge resource to them.
Absolutely. And we're comfortable giving you the whole slide presentation, Susan. So
that would be great. Yeah, that would be really helpful. Do we have, again, I know we don't have maybe as many members who are live with us today, but I don't want to miss the opportunity if we have folks who might have questions.
Cyndee, this is Lynn. I don't have a bunch of questions, but I sure am grateful for the slides. We're in the process of updating some of our CE courses that include a section on flood insurance. And these are wonderful because we'll be able to give the new courses that we're putting together for approval, be able to put the most recent information into them. Thank you so much for that.
You're welcome. I will just point out one area that you may get questions about and just give you a little background. The two areas, I guess, that we've gotten feedback where people are questioning the new limit on paying more on that insurance are homes that are elevated. So in the past, as Austin showed you, they could pay $500 regardless of their value. And again, what I would say to you to understand is that, again, as we saw the value to remediate and bring back after a flood event, the more expensive and larger the home, the common sense is the more it's going to take. And so those individuals who, many of whom made decisions based on the old, have expressed frustration. But in the end of the day, the reality is this is actuarially sound. And so, unfortunately, the system we were working on, it was like a random dart. And at some point you have to say, like, this is where we are. And if those people had flood insurance already, then they're on that glide path from $500 to whatever that number is. If they did not, then they may, then they have to start just like I did, right, at whatever the rate is. The other thing is for new construction. And again, many of them might have been building in flood zones, but traditionally, if you were building to code, then you would get that really artificially low rate. Just understand again, I mean, at some point we have to base it on the science and on good information, and that's where we are. So, going forward, all of that'll be known. Those people, I would say, were the ones who needed some extra conversation and understanding about what was going on. And hopefully with that, you can explain to them why, but it really comes down to value. So, in our area, most new construction, I mean, the average home has gotten up to 400,000, but, a lot of new construction will be higher priced homes. And so again, it only makes sense that should we have an event, the cost to remediate is going to be more than, $500. So, and then I guess the other thing is in X zones, you may get some calls where people, their neighbor had $400 and they're like, now, okay, I want to get it. And they're saying, well, okay, that rate's quite a bit higher because it's now based on that risk. Now, one of the things we all kind of smile with that whole X zone, which is the non-mandatory flood insurance, is that most people that want it already know they're at risk. Like the slide that Austin showed you, they know the river's across and they know that, they could have got it for 400. And they're like, yeah, I probably ought to do that. So again, if you get some of those questions, we're here to clarify if somebody's asking, like, why me? But those are things where you are going to see an adjustment. And so the biggest things to remember are if they currently have a plan, they're not, if they haven't been complaining to you up until now, which again, I live at ground zero, nobody was complaining, then they're not going to complain with the new system. If they didn't have it and you go to sell it, or the big thing is, again, if you work in an area where you have a lot of retirees, they're self-insured, low risk, the one other thing to know is if somebody moves from an X zone where it's not required to a mandatory zone, reach out to Austin because there is a smaller glide path to help people do that. So there is something that if the mapping were to change and it would go from an X to a required mandatory flood zone, that currently there is a little bit of consideration for that. Did I say that right, Austin? I think consideration.
Yes. So there's a grandfathering. It's called the newly mapped grandfathered rate. So you don't just go from the whatever you're paying to the full risk rate overnight.
Yeah.
You would start below that rate and then adjust gradually.
So let me make just a few maybe observations, some Virginia centric notes as well, as I sit here in an elevated home in an X zone in Jacksonville, North Carolina. And my son did make the decision to go ahead and get the insurance. He just, knowing he may not be home when events were to happen, he wanted that added sense of confidence. And I will say, Austin, you would be very proud. When John was buying this house, when our son was buying this house, I was amazed when he called me one afternoon after he, of course, Lynn and Cyndee engaged a realtor. He called one afternoon and said, I know all about NFIP now. I understand it. I'm not afraid of it. I have a great insurance agent. I have a great realtor. I've done an elevation certificate. I went through the MAP servicing center at FEMA. I understand my risk. I mean, he did all that work as a 24-year-old buyer. And I think one of the morals of the story that I've seen over the years is how much more user-friendly this construct is to what had been out there before, where consumers, I think, often struggled to get information that they felt was reliable. And I think with the technology enhancements and with the amount of information that you can even find on FEMA's website, one of the websites that you noted in your resources slide, Cyndee and Austin, there is so much information out there that allows consumers to obtain that information and feather in the hat of the realtors and to work with those local experts. It really is, I think, much more consumer friendly than the 50-year-old model that had never changed. And I think we will now see those more regular updates to keep things much more timely in terms of the information that's going to be available, because we do have, at least now, I think with 2.0, sort of that base that from this point going forward, that will be the model by which to help consumers with those decisions. Because to your point too, Cyndee, you all need to be the source of the source, not the purported expert. You all are the source of the source. But you noted too, in your remarks about what we've been able to do in Virginia with our flood risk information form that is now part of the disclosure, the buyer beware information that we put out to, that you all as realtors provide to consumers. And we have really worked very closely with NAR, our key niche flood expert legislators in the region have been extremely helpful, both at the federal level and at the General Assembly level. And so this is one of our hallmark issues now. I would maybe even start to call it a legacy issue, because we really are at the tip of the spear in Hampton Road, surrounded by water everywhere, because this is something that our members deal with every day. So just a few closing observations and remarks that I wanted to put out to our members, and we can give so much more information, which I think actually is something we want to talk to you all about for maybe 2023, is helping to create a flood panel where we would want definitely you, Austin, and Cyndee, you as well, as I think by then you would be perhaps the chair of the insurance committee, help us really do sort of a broad panel, because as we've seen, there is so much information out there. And you all have just been a huge source of it today, and I am grateful to you. And I think our members are going to be extremely well informed when they look through this a few times. And I think for many of them, it will take a few times for it to really sink in, no pun intended.
Well, we look forward to continue to support your efforts. I speak for myself, and I'm sure Austin, because we don't call him the flood man for nothing. So we can't, we if there's a flood topic, we like to be there. I also think that, one of the opportunities, at least I've experienced in this journey, is that when we as realtors are comfortable explaining this to people in a way that is charge neutral, then we allow the consumer to make the decision that's right for them. I will tell you that last December, I had a property that was going to be $1.2 million and it did not have flood on it. And before I wrote the offer, I said, you know, I think you need to look at the insurance quotes and make sure you're comfortable, right? And the client he was paying cash, and the client got the quotes and he said, I think his rate was close to $12,000. And he said, well, that looks about right for the risk. But I think that again, sometimes we put our own, I don't know, our own spin on things. And I've even had some local realtors here in Tampa Bay who, you know, who said, oh my gosh, this is going to crash the market. And my answer to them is, you know, you can crash a market. What you say about properties, how you approach it will be, you know, amplified. And is that truth? And I can tell you from my own place I work, I used to be the president of the Pinellas Realtor Organization. We have 10,000 members here. And again, we're ground zero. But Austin and I have been doing this presentation around the country as well as in my own backyard. And we have yet to have one realtor or one consumer complaint. But specifically our CEO, I check in with him and I'm like, what do you know, is it impacting sales, deals, whatever? And it's not. But it will if people don't understand it and then there's a change. Again, it will if people aren't asking sellers for the declaration page up front and helping make that smooth transition, right? So all of those things are important, and we are the leader of the transaction and we are the leader on this issue, and our clients look for us to be that, again, that source of the source, but we don't need to be the person yelling fire in a room either. And so, so many people, you know, who are not informed really can do a lot of damage one way or the other. So, you know, I'm really, again, grateful that you guys are making this available to your members, who obviously it's an important topic and issue for you as well, because that is where we continue to show who we are and why realtors matter.
Cyndee, Susan, and Austin, thank you so much. I'm afraid we have run over our time and we're going to have to wind this up. But thank you for your time. Thank you for the information. And we'll look forward to a lot of our members seeing this on YouTube. Thank you. Have a good
Thanks, you
day.
guys. We
Bye-bye.
really appreciate it. It's good to see you. See you in person soon, I hope, Austin. Bye. Thank you, Cyndee. Be safe.
Bye. Have a good day.